Welcome to Self-Made Verse. March 2026. The Indian rupee crashes past 93 per dollar, the lowest in the country's history. But this isn't just a number on a screen. Every time you fill petrol, buy groceries, or book a flight, you're feeling the impact of this historic collapse. Alright, before we get with the details, let me quickly walk you through what this video covers. First, we'll trace the rupee's journey from 60 to 93, understanding how we got here over the past decade. Then we'll examine the oil crisis that triggered this latest fall, because India imports over 80% of its energy needs. We'll break down the 6 fundamental reasons behind rupee weakness, from current account deficits to Federal Reserve policies. The data tells a compelling story: 8.8% depreciation this year alone, the worst since 2014. And finally, we'll explore what India can realistically do to stabilize its currency, and whether this depreciation is always bad news. Now let's understand each of these properly, starting from the beginning. To understand today's rupees 93 crisis, think of the rupee like water in a bucket with a hole. Money flows in through exports and foreign investment, but it leaks out through oil imports and foreign investors exiting. When outflows exceed inflows, the rupee falls. If the leaks exceed the inflow, the bucket level falls. That falling level is currency depreciation. And here's the 10-year arc that tells the complete story. But here's the deeper truth that catches most people off guard. This isn't a crisis unique to the current government or the current decade. The Indian rupee has been on a deliberate, consistent depreciation journey since the 1991 liberalization. From 17 rupees in 1991 to 90 rupees in 2025, that's 34 years of losing roughly 4.5% per year on average. Now that we understand this historical context, let's examine what makes the rupee rise or fall. Before diving into specific causes, every UPSC aspirant must understand the basic mechanics. The rupee's value against the dollar is like any other price, determined by demand and supply. But here's where things get complicated. 6 fundamental forces are pushing the rupee down. And the first one, India's oil addiction, is the most structural, most persistent cause of rupee weakness. Think of oil like milk for a household. Every day, the family must go to the market and buy milk with cash. If the price of milk doubles, the family spends twice as much cash. That cash leaving the household is money that can no longer be saved or invested. For India, oil is that essential daily purchase, and it must be paid in dollars, not rupees. When the West Asia War erupted in February 2026, and Brent crude climbed above $105 to $111 per barrel, India's import bill exploded. Every extra dollar spent on oil is a dollar demand that pushes the rupee down. The second force, the current account deficit, is the economy's credit card bill. It's the gap between what India receives from the rest of the world and what it pays out. When India consistently imports more than it exports, it must borrow or attract foreign investment to bridge that gap. And the numbers are stark. India's current account deficit rose to $13.2 billion. That's 1.3% of GDP in the third quarter. The moment that bridge of foreign money weakens, the rupee falls. The third force is foreign portfolio investment outflows. When foreign money leaves in a hurry, foreign portfolio investors are like short-term tenants in India's financial markets. They buy Indian stocks and bonds when returns look attractive. But unlike long-term investors who build factories, FPs can leave within minutes, electronically. When they leave, they sell rupees and buy dollars. That sudden dollar demand hammers the rupee. And in March 2026, foreign portfolio investors accelerated their retreat, pulling more than $11 billion from Indian markets, the sharpest monthly outflow since October 2024. But why do FPs leave? That brings us to the fourth force, the US Federal Reserve effect. The US Federal Reserve is the world's most powerful central bank. When it raises interest rates, US government bonds become very attractive, safe, liquid, and now paying higher returns. Global money floods back to America. Imagine two banks, Indian bank offering 6% interest, US bank offering 5%. Investors choose Indian bank, where US bank raises to 5.5%. Some investors shift, US bank raises again to 5.25%. More investors shift. The interest rate differential is a constant gravitational force on rupee. The fifth force is the dollar smile phenomenon. The dollar strengthens both when the US economy is booming and when the global economy is in crisis. Investors want US assets during good times and they run to the safe haven during bad times. The dollar only weakens when the US economy is slowing but the rest of the world is doing fine. That sweet spot is rare. And finally, the sixth force, India's structural import dependence. Beyond oil, India is heavily dependent on imports of electronics, fertilizers, edible oils, gold, and critical minerals. Every iPhone assembled in India uses imported chips. Every car uses imported steel components. Every kilo of fertilizer contains imported urea. This structural import dependency means India perpetually has more dollar demand than dollar supply. And the numbers confirm this structural challenge. India's trade deficit hit $27.35 billion in July 2025, driven by high imports of crude oil and electronics. These six forces working together explain why the rupee is at historic lows. Let's put this in perspective with hard data. The rupee has depreciated 8.8% against the dollar in the current financial year, the worst performance since 2014, when it fell 9.37%. India's foreign exchange reserves have fallen from a peak of $728.5 billion to $709.8 billion. The real effective exchange rate, which adjusts for inflation differences, has fallen by nearly 9.9%. This is crucial because it shows the rupee's depreciation isn't just a nominal adjustment, but an erosion of India's real competitiveness in global markets. So what does all this mean for ordinary Indians? When the rupee falls, the household bill rises. Every product that contains imported oil becomes more expensive. Petrol, diesel, LPG, plastics, fertilizers, medicines. The depreciating rupee feeds directly into inflation. Companies with foreign debt face higher repayment costs. India's outstanding external commercial borrowings were about $44.36 billion as of December 2025. Every rupee of depreciation increases their repayment burden. But there's a silver lining that UPSC mains questions frequently ask about. IT and pharma companies benefit significantly. An IT company that earns in dollars and pays salaries in rupees makes more rupees for every dollar earned when the rupee depreciates. Export-oriented sectors see their profit margins improve. NREs also benefit temporarily. The depreciating rupee means each dollar sent back to India converts into more rupees, motivating NREs to remit larger amounts and inject more money into the economy. Given this reality, what can India do? The Reserve Bank of India doesn't sit idle while the rupee falls. It has several tools in its arsenal, each with important trade-offs. First, direct market intervention. The RBI sells dollars from its foreign exchange reserves directly into the market, increasing dollar supply and supporting the rupee. Between November 2024 and November 2025, the RBI sold nearly $50 billion. The risk? This depletes reserves needed for crisis management. Second, raising interest rates. When the RBI raises its repo rate, borrowing becomes expensive, money supply reduces, and Indian assets become more attractive to foreign investors. The trade-off? Higher rates slow economic growth. Third, rupee internationalization through special rupee vostro accounts. Rather than paying in dollars for trade, partner countries can pay in rupees through special accounts. 83 banks from 35 countries have opened these accounts. If India and Russia trade in rupees, neither needs dollars, reducing structural dollar demand. But can India truly stabilize the rupee? The honest answer requires understanding realistic conditions. The rupee will not suddenly strengthen to 60 or 70, but there are genuine conditions under which it can stabilize and even gradually strengthen. First, reducing oil import dependence. India's renewable energy capacity reached 520 gigawatts in January 2026. Every solar panel installed, every electric vehicle on roads, every green hydrogen plant commissioned reduces oil dollars leaving India. This is not just climate policy, it's currency policy. Before we wrap up, let's quickly revise the key terms you should remember for the exam. Current account deficit, the gap between what India receives and pays to the world, near and rear, nominal versus real effective exchange rates, with RER being the true competitiveness measure. Special rupee Vostro accounts, allowing trade settlement in rupees instead of dollars, and external commercial borrowings, foreign debt that becomes costlier when the rupee weakens. Stepping back to see the bigger picture, the rupee's journey from 60 to 93 tells a deeper story about India's structural economic challenges. This isn't just about currency management, it's about the fundamental gap between what India produces for the world and what it buys from it. The real challenge isn't to make the rupee strong by defending an artificial level. The challenge is to build structural conditions, energy self-sufficiency, export competitiveness, deep financial markets, and low inflation that allow the rupee's value to be determined by genuine economic strength rather than perpetual intervention. If this analysis helped clarify the rupee's complex story, subscribe for more comprehensive UPSC content. Understanding these economic fundamentals will serve you well beyond just the exam. Here are the key takeaways you must remember. India's rupee hit a historic low of 93.5 per dollar in March 2026, driven by oil price surge and geopolitical tensions. 6 structural forces drive rupee weakness: oil dependence, current account deficit, FPI outflows, Fed policy, dollar strength, and import dependence. The RBI has intervention tools, but each comes with economic trade-offs. Gradual depreciation can actually benefit export sectors like IT and pharmaceuticals. Long-term rupee stability requires fundamental economic restructuring, not just currency defense. For UPSC preparation, this topic connects directly to multiple dimensions. In prelims, focus on RBI tools, repo rate, CRR, SLR, and their impact on currency. For mains GS3, you should evaluate factors behind India's current account deficit and analyze the relationship between exchange rates and export competitiveness. Essay questions might ask whether India can achieve full capital account convertibility. In interview rounds, you could be asked about India's exchange rate policy and the balance between currency stability and export promotion.